ladies and gentlemen. Welcome to a joint session of the Transportation, Infrastructure, Energy and Environment Committee and our Government Operations Committee. The legislation that we are considering today touches great music. Great. No, we need that lift. We need that lift.
The disco is in session.
The disco is in session. That's good. This is a work session only today. One of my colleagues asked it to be a work session, Tom Hucker, and then it turns out that Mr. Hucker has to be a good dad and take care of his sick boy. And dad comes first, so totally understood that he couldn't be here. But given the controversy with respect to this legislation, it felt like it was appropriate to have a work session as opposed to a voting session. And so the chair of the GO committee and I thought that that was a more prudent way to proceed. I will be chairing our joint session today. I will turn to staff in a moment and just make it, and I will turn on the lights. I get a lot of help how to do this. And I need a lot of help. So let me just make a couple of observations to begin with, and then we can have whatever conversation my colleagues feel is necessary. We have representatives of the Board of Investment Trustees here. Gene Oren is the chair of the board, and I'm happy to have him come forth and give his views with respect to this. I don't have in mind a representative of people that have an alternative view, but I will do my best to represent that perspective to the extent necessary. But let me just share with those watching today what my goal was from day one with respect to this legislation, that I felt that we could both be true to our values and what many of us believe to be an existential threat to our planet, and be true to our retirees, that this was not an either-or situation. This was designed from day one to be able to advance both. I said it when we introduced the legislation that I did not expect our retirees to suffer as a result of our going forward and meeting the values that I think this council and this county hold with respect to our environment, in which many of us have worked real hard in terms of passing legislation. So the notion that we would be profiting from the very companies who are undermining all the work that we've done in this county seemed me to be incongruous and inappropriate. If, in fact, we could replace those individual stocks with stocks that perform as well or better. It was not designed to reduce in any way, shape, or form the returns that our retirees receive that are so terribly important to our retirees. And a number of us are getting to the age where we all look at that portion of our portfolio and we say, we don't want that reduced, thank you very much. Totally understand. So when I introduced the bill had language in it that said, the fiduciary duty comes first. We thought that that was sufficient. I think Mr. Drummer and I all thought that that was sufficient, that there was an understanding with respect to that. Our county attorney came back and said, actually, you didn't achieve that objective. So after 10 drafts, I think we did achieve that objective, in which the legislation makes it absolutely clear that the Board of Investment Trustees' responsibility is first and foremost to honor their fiduciary duty. We can do nothing short of that as a matter of law. Okay? Fiduciary duty wins. And if in the exercising of your fiduciary duty, you can replace these stocks with other stocks, you should do so. And you should go to your investment managers and you should say, you ought to look at this. Can you replace poor performing coal stocks with other stocks that are of equal or better value. Now people say, how can you make that judgment? Well, we make that judgment every day. You pick some stocks and you have other stocks. People make those judgments every day. There's no guarantees, but that's why you have investment managers, and you turn to them and you say, we'd like you to consider this. Now, I met for almost an hour with the Board of Investment Trustees to explain my perspective, which I just have. And quite frankly, I didn't make a sale. I've been trying to find common ground on this issue for a long time. And here's why I think ultimately we can't find common ground. Because the Board of Investment Trustees says, as a matter of principle, you should not tell us how to do our work. Well, I understand that point of view. The Board of Investment Trustees has done well by our retirees. Okay? It's a well-done fund. I hear that. But the reality is, I believe that in today's environment, any manager is looking at these sets of issues anyway. In fact, the Board of Investment Trustees says, Roger, we don't need to do this because we've got an ESG policy. So I asked, well, what does that ESG policy, what has it done? And quite frankly, we didn't get a very satisfactory answer to that. What we got was that all the managers that we pick are required to look at environmental, social, and governance issues. But when I asked for any specific action that was taken and consistent with that, because I'm wondering, how can you have coal stocks and have an environmental, social, and governance policy? He said, well, actually, we leave that to the managers. It is part of what they are to, quote, consider. It doesn't trump anything else, pardon the expression. It is something that is to, yeah, I know, we have to come up with another word. It is just something that they have to take into account. Doesn't mean that they make a decision on that basis. They just have to take it into account. Well, for some of us, that's not enough. So all this legislation fundamentally does at the end of the day, in order to make sure that it honors the fiduciary duty, is just say, managers, will you look at this? And will you report back? And if you report back and say you can't do this because it would violate your fiduciary duty, then that's the answer. But if you're not looking at this on an ongoing basis and trying to figure out, can you get out of these stocks and do as well, if not better? That's what this legislation fundamentally calls for. So I sort of regret, we've gotten a lot of mail from the retirees, and you are here, and we see you, and you know, I just say to you in my whole heart, I am not trying to reduce your returns. This legislation would be unlawful if it did. So from my perspective, the whole goal of this was to achieve a win-win. And I still think we can. Let me turn to any colleagues who have opening thoughts of their own that they care to make. Ms. Florine, you have your light on.
Well, I don't have a speech. I just had some questions. So whenever that's appropriate, I'd like to ask those.
Mr. Drummer, did you want to walk us through the bill at this point? There were a number of amendments. I've asked Mr. Drummer, and the packet reflects that there is now a, quote, clean version of the bill, because there were a number of amendments in order to ensure that this was legal, in order to ensure, again, that we didn't impose a duty on our Board of Investment Trustees that would be violative of law. So, Mr. Drummer, take it away.
Thank you. Good morning. Just first, so we all know what we're talking about, there are two trust funds that are affected by this bill. One is for the retirement systems, I can say that, and that's managed by the Board of Investment Trustees. The second one is what we call the OPEB fund, or the Other Post-Employment Benefits Fund, which is managed by the Consolidated Retiree Health Benefits Trust Board of Trustees. I'd make fun of who created that name, but I think I wrote it. And that fund is a separate fund, and it's used, it's expected to be used to pay for retiree health insurance benefits and other benefits of that nature, that it's not the actual retirement pension plan. And I can go through the original bill if you'd like, or just start with the amended bill. Let me just, so you can understand the differences, let me just go quickly through the original bill. The original bill is starting on Circle 1, and it has a definition of a fossil fuel company, which is important so you know what you're talking about. And it defines a fossil fuel company as a company listed in the 200 publicly traded coal, oil, and gas companies that hold reported fossil fuel reserves with the largest potential carbon emissions, as ranked in the fossil free indexes U.S. published by the Fossil Free Indexes LLC, or a successor index, as updated annually. So there's actually an index of the 200 companies with the most fossil fuel reserves, and those are the companies we're talking about. That can change over time, obviously, so it needs to be continually updated. The original bill would then require divestment of the investments in these 200 companies by either board over a period of 5 years, if possible. And then does permit a delay if the manager believes that it would violate their fiduciary duty to go ahead and sell a company at that point, and they would not be permitted to purchase new fossil fuel companies. It also requires research on socially responsible investing, which we'll talk about later, and requires that the board provide notice to a company before the board divests from that company, and give them an opportunity to show several things that are in their exemptions. The exemptions are that the company has stopped exploring for new hydrocarbons, agrees to not develop or sell 80% of its fossil fuel reserves, and has stopped lobbying or attempting to influence government officials to preserve its special treatment, including subsidies, tax breaks, or competitive advantage with respect to clean, renewable energy. And it also requires a report. That's the original bill. The county attorney raised 3 legal issues. The first one was an unlawful delegation of legislative authority to private persons. That would be the company that provides the listing of the 200 largest fossil fuel companies. And that essentially you can't have a private company telling you who you should divest from. That's fairly easy to fix, and is fixed in the amended bill, draft 11, which simply changes the requirement that they rely on that list exclusively to, they can refer to it, but they can also make their own decision who's in the top 200 for fossil fuel reserves. The second one is the lobbying restriction, that would be a violation of the First Amendment, that you can't condition a government benefit on giving up your First Amendment rights to lobby the government. And the First Amendment rights we're talking about is the First Amendment rights of those corporations that you're divesting from, the fossil fuel companies. That's also handled in the draft 11, which is on starts on Circle 85, the amended bill, although the bill hasn't actually been amended yet. And then the third and most complicated issue was the fiduciary duty. And spend a little bit of time talking about the fiduciary duty that the Board of Trustees and the individual managers both have. It's set forth in statute, and I've quoted the statute on, there's two statutes, one for each board, starting on page 3 of the memo. The most important aspect of it is the money put in these trust funds is for the exclusive benefit of the beneficiaries. In this case, they're the employees, the current employees, and the retirees. And so the whatever you do with the money, you're supposed to do it only in the benefit of the retirees, who are the beneficiaries. And the sole purpose is to provide benefits to the beneficiaries. In other words, to ensure that there's enough money in the funds to pay the benefits that have been promised. That's the fiduciary duty that we're talking about, and it's pretty standard. It's it's in the county code. It's also required to be in the county, to be in the retirement plan by a state law, and it is the common law in the United States for fiduciaries in dealing with retirement trust funds. It's also there's also a federal statute which doesn't actually apply to us because we're a government-sponsored plan, the Erisa Employees Retirement Income Security Act, which would apply to private sector retirement funds, and they have a very similar fiduciary duty. And in fact, I included in the packet on interpretive bulletin from the Department of Labor that was issued last year on Circle 53, which explains the Department of Labor's views on what they call what do they call it? Let me see, I forgot exactly what they call it, but yeah, the Employee Security Act. But the interpretive bulletin is Department of Labor's interpretive bulletin regarding what they call economically targeted investments. And what they mean by that is the same what we mean by socially responsible investing, is that you're looking at a collateral economic factor or social factor in addition to the typical risk-return financial analysis of the stock. You know, is this a good investment? Is it going to do well over time? And the Department of Labor says, at least for ERISA plans, that you can look at these factors, but you can't make your judgments based upon economic factors at the expense of the financial risk-return analysis. In other words, if all things are equal and you have an alternative investment that you believe is going to do as well, then you're free to drop an investment for an alternative for collateral reasons. And it also, they provide that there are situations where the fiduciary may believe that what's considered a collateral issue actually has a direct effect on the value of the fund. In other words, socially responsible investing is based on a theory that if the company has, I guess, what the fiduciary considered good values with regard to certain collateral issues, the ESG stands for environmental, how you treat the environment. Social is how you treat your employees and how you treat your customers. And then governance is how you deal with your internal governance. And a good example is executive pay. And the belief is that companies that follow good principles in these areas will do better over time. So we should look to them, and we believe that does have an intrinsic value on the overall value of the investment. So if you believe it's going to have so this is not the easiest thing for me to explain. I could see I'm getting quizzical looks, but there's two bases under the Department of Labor standard where you can look at collateral factors. One is, all things being equal, go with the stock that you, or the bond for the company, go with the company that you believe, is the better actor in whatever collateral factor you're looking at. In this case would be fossil fuels. The second one is if you believe that the fossil fuel industry, let's say for instance, if you're in coal, and you believe coal's a dying industry, well, their metrics may look good at the moment, but they're not going to be over time, then you may want to get rid of it because they're in coal. That's not really doing it because you have a blanket rule to not invest in coal. It's because you believe that coal is it really hurts the value of that company. The company's not going to do well over time. That's the direct relationship, if you really think it has a direct relationship. The boards, neither board actually makes these decisions on individual securities, either stocks or bonds. What they do is they hire investment managers to do that. In fact, that's what they're required to do under the county law. We don't appoint people for, that's a full-time job to run a portfolio, and it takes a certain expertise. So they hire the managers. So what we're talking about is asking investment managers to make these decisions. Let me go over the draft Bill 11, starting on Circle 85. I actually, if you look on the packet, rather than looking at the bill itself, starting on page 6, I listed what the changes are in draft Bill 11. And the first is to add findings. Findings they're nice. They give you an idea of what the bill is about and why the council did this. They have no actual effect on the law. Then there's a technical change. Just this was something brought up by the board. We had originally, let me just point this out. The bill never tried to prohibit fossil fuel companies in what we call commingled accounts, because if you do that, you can't do any investment in commingled accounts. In other words, if you buy a mutual fund, you don't have any control on what the mutual fund buys, and especially if you buy an index fund. If you buy a fund of that's an index of the top 500 companies, well, you have no control over who the top 500 companies. So we're only talking about actively managed separate accounts, which both boards have. And that means that they've hired an investment manager to make individual decisions about which stocks or bonds to purchase.
And I believe the total number is something on the order of $70 million.
In fossil fuel companies.
Yes.
Yeah, right.
Individual stocks, bonds. It is
Right.
a small percentage of the overall portfolios.
The second change here is just simply a technical change. We wrote down real estate fund. What the better term, which covers really what the board does, is private real asset fund. They're not all real estate. And then we made the change in the change in the definition of fossil fuel company that I mentioned briefly to avoid the unlawful delegation. It simply says that, there's this list, you can refer to it, but make your own decision as to who's a fossil fuel company, and you can hire a consultant if you need to get help doing that. We added a definition of socially responsible investing, and I tried to describe that earlier, and that's on Circle 88. We clarified, and this is just to clarify real life, that the boards must direct their investment managers to review these investments, because it's the investment managers who actually make the decisions, individual investment managers. We took out the mandatory divestment of fossil fuels companies over 5 years in recognition of the legal restraints we're talking about in fiduciary duty. In other words, that was just a blanket get rid of them. We're making the judgment for you that these stocks are not something you should hold, that's going beyond, I think, what we can require for the Board of Investment Trustees. And then we made it clear, subject to the fiduciary duty, which is set forth in the code already, require the boards to divest under two circumstances I talked about. And we use the de minimis if going to an alternative investment would have a de minimis impact on your portion, the individual manager's portfolio, because none of the managers manage all the money. It's split among many different managers. The de minimis standard is not something I made up. It comes from the Court of Appeals case back in 1986. I'm sure many of you remember divestment in, I remember 1986. The Mets won the pennant. Lost in the World, and the World Series, right? And the Court of Appeals reviewed a divestment law in Baltimore City requiring the city retirement plan to divest in certain companies doing business in the Republic of South Africa due to the apartheid laws. And in that decision, the Court of Appeals ultimately, there was actually a trial in that case as to what effect it would have on the trust fund itself. And they actually came up with evidence of numbers. I don't know how they ever did that, but there were not that many companies that you needed to divest from in South Africa because there was a way for a company doing business in South Africa to avoid divestment by following what they called the Sullivan Principles. And in that case, the court concluded that the potential loss to the trust fund was de minimis. In other words, it was minimal. It was, and they actually had a number in there, and it was less than 1/32 of a percent or something like that. So in those circumstances, that was okay. So that's where we got the de minimis standard from. Then we also required the boards to work towards divestment, essentially in actively managed separate accounts by applying the Department of Labor's interpretive bulletin, all things being equal, or if you really believe it's going to have it affects the intrinsic value of the company itself. But no requirement that you divest, within a certain number of years. And it's all subject to the fiduciary duty. And then we added a provision that clarifies just that the fiduciary duty comes first. And we deleted the provision dealing with writing to fossil fuel companies and providing an exemption if they do certain things that we like, as kind of unworkable, to tell you the truth, because the investment managers are making these decisions, and timing is important. A good stock today, a good investment today may not be a good investment 6 hours from now, much less 3 weeks from now after we do some correspondence back and forth with a company and find out what they're doing. It's just unworkable for managers to do that and continue to make decisions in the best interest of the board. So we took that out. It requires the boards to consider an investment manager's policies on socially responsible investing, including their manager's policy on investing in fossil fuel companies when we select an investment manager. In other words, are they willing to work with us on this because this is important to us, and they should consider that when they hire an investment manager. And deletes the requirement for the board I mentioned that, to have this correspondence with a fossil fuel company. And then requires reporting, beefs up the reporting requirement that was in the original bill, that if you're not divesting from, if you're either buying a fossil fuel company or you're not a retaining one on an annual basis, we'd like an explanation in the aggregate of why not. And that's the amended bill. The amended bill was really a joint effort between the lead sponsor, Mr. Berliner, myself, and the county attorney. So we've gotten clearance from the county attorney, and I certainly agree with it, that the bill as drafted in draft bill 11 is legally sufficient and does not violate the fiduciary duty. Just a word quickly about the fiscal impact. We don't have a fiscal impact statement yet from the Department of Management and Budget, or an economic statement from Finance. They did ask for an extension of time and promised to have it here on or before February 13th. So we don't have that. That's going to be, I think, a difficult thing for them to calculate. But in any event, it would be helpful to have, because we believe that there will be some cost to actually, for the Board of Trustees to implement this. But we don't really know how much. And that's the revised bill. So I'm open for questions.
Thank you, Mr. Drummer. I will now turn to Ms. Florine, who has a question.
Hey, thank you. Okay, I'm going to ask questions that are going to reveal things I should know the answers to some of this, but it would be helpful for me to understand this. So this applies to the Employees Retirement Fund and the Employees Health Benefits Fund.
That's correct.
How much money are we talking about?
Well, I think
In
Linda
those
Herman is
funds.
here. She probably can give you the exact numbers. I don't actually know right now, but Linda Herman's the executive director for the retirement funds.
Whoever could answer my question. I
It's
mean,
about-
I've been told, but I don't have it right here.
Sure. The ERS has about $3.6 billion in assets.
3.6.
Right. The Retiree Health Benefit Trust has almost $800 million. And then there's another roughly $80 million contribution that's coming in this fiscal year to the trust from the county. So it'll be almost $900 million.
So that's what this bill explicitly applies to. Of course,
Yes.
there's some exclusions, and all that. I understand that, but that's the size of those funds. Now, are these the only investment funds that the county has?
No, the county has two other retirement plans. One is the Retirement Savings Plan. Many of you either participate in the Retirement Savings Plan or the Guaranteed Retirement Income Plan.
Well, that's the other, and let's back up. There's a plan that applies to only people who got into the plan prior to 94, I think, or that where entry was closed as in 94. That's what we're talking about here?
Right, you're talking about the plan that has all employees hired prior to 1994 in it, and all public safety employees hired after 1994. So keep in mind that the plan
Because
is
that's the
still
defined
open.
benefit plan.
That's the defined benefit plan,
Yeah.
yes.
So for everybody else, we have the,
They're either
Money-
in the Retirement Savings Plan, which the Board of Investment Trustees selects investment options to be offered to those individuals, along with a self-directed brokerage window that they can pick their own options. That pool of money is around $400 million. It has about 3,800 employees in it. Then you have the Guaranteed Retirement Income Plan, where employees are
Correct.
guaranteed an interest rate, currently 7.25%. There's about 2,000 employees in that plan. Assets maybe around $200 million.
so, and this does not apply to them.
No, nor does it apply to the deferred comp plan. Well, it applies to GRIP. The GRIP it does, yeah.
The employees in the guaranteed retirement income plan, their money is invested along with the defined benefit money, so it would apply to them.
Yes.
It doesn't
So
apply to the...
It would apply to them, the people
GRIP.
in the
It would
GRIP.
apply to those 2,000 employees, not to the 3,800 that are in the retirement savings plan.
So do they know that this legislation would apply to those plans? Okay, they've been informed. Now, the county manages a lot of money. We've got a $5 billion budget. That is not affected by this. But that money flows through a bank somewhere, right?
Yeah.
I think it's in Pennsylvania.
I don't believe
is
we have
terrible.
money, though. The general fund money is not invested in the same way. I mean,
No, it's invested in short-term cash. The Department of Finance
So
invests
that's in
those funds.
cash.
It's in short-term cash, usually a duration less than 1 year, and generally AAA, AA rated types of securities.
And so do we have other short-term investments that we use to manage our money flow? I assume we must.
Yeah, I don't
I don't really know.
Yeah, that would be,
Again, I've probably been told this, but I don't recall. Mr. Wren, do you,
Yeah, I just want to add as well,
observation.
just so all the pieces are on the table. The firefighters drop plan is commingled in this as well.
so the drop is included in
Just
what
the
you guys
just the
manage?
firefighters, not
Yeah.
the other two.
Right, right. I know they're different plans. So, and then we're talking about, and the council president alluded to this earlier, this is restricted to actively managed separate accounts.
correct.
So what percentage of all that money, we're talking about almost $5 billion, 4.5. What percentage of that money are we talking about here?
70 to 80%.
70 to 80% is
Oh.
in actively managed separate accounts?
Yes, the money that isn't in the actively managed separate accounts is invested in limited liability partnerships, private equity, private real assets, or commingled vehicles, hedge funds, things of that nature.
So this is not a small segment of this. This is a very large segment of the investment portfolio.
Yes.
Okay, that's helpful for me to understand. And so we're talking about how the choices made for 80% of so about almost $4 billion, $3.5 billion we're talking about here. Okay,
Yes.
thanks.
Mr. Reamer?
Thank you very much. I wanted to get a better understanding of the Department of Labor regulation or clarification. On the one hand, it seems like it's permissive, right? It says that economically targeted investments can be consistent with Erisa, but then it qualifies that by saying that under Erisa, the plan trustee or other investing fiduciary may not use plan assets to promote social, environmental, or other public policy causes at the expense of the financial interests of the plan's participants and beneficiaries.
Right. That's what I was trying to say. Is it you can do it if you think it's not going to affect the ultimate returns. In other words, all things being equal, or if you believe that is a reason to not buy the stock, because either way you're saying.
So you could
either way, you're
construct-
looking at this collateral factor,
Yeah.
which is not typical or standard risk return analysis, and making a judgment that I'm doing this for reasons that will not affect the ultimate value or won't lower the ultimate value. If you're doing it because you think the collateral factor will reduce the value of the company, you may actually be doing it because you think you're going to get a better return by divesting of a company in an industry that you feel has less value than it should. But those are judgments that need to be made by the fiduciary, in this case the individual investment manager. It's difficult to make them, where you get in trouble is if you try and make them through legislation when you're saying, in other words, you can tell the investment managers to follow the Department of Labor standard, but you can't just say without yourself looking at all these individual stocks that this particular stock you should sell, because we believe this factor makes this stock worthless. Because that's what you're paying the investment manager. That's what the fiduciaries do.
So what would happen if the plan were to take an action that, was challenged under that regulation? Could, we have testimony from each of the county employee unions opposed to the legislation. If they did not like the decisions that were being made, would they be able to challenge those decisions under Erisa?
No.
No.
The ERISA doesn't actually apply to us in this circumstance. They could challenge the law in court saying it's illegal.
Could challenge the law in court.
The law in court. I don't think they could challenge, I think they wouldn't get very far challenging an individual decision to sell ExxonMobil or something like that, saying, why did you sell ExxonMobil? They would have to challenge, I believe, the law. They wouldn't be challenging individual investment decisions.
They have to challenge the law, but then this ERISA rule is relevant to that, or this is a completely separate path?
It's relevant only to the extent that the fiduciary standard is virtually the same under our code and ERISA. Here's an interpretation from the Department of Labor, although I will say the former Department of Labor. We don't know how the current Department of Labor.
Tom Perez, I should note.
Right. This is more like Tom Perez's idea
this.
of what.
Let's give him a call.
Right, he could probably explain it to you.
Right.
But this is it's relevant only because we have the same fiduciary duty. It's not legally binding on us.
Okay.
This interpretive bulletin, but it is persuasive because it's how the Department of Labor feels that you can look at collateral, economically targeted investments.
Okay, that's helpful.
That's why we're using it.
In any event, it comes down to the same basic fiduciary standard,
Absolutely.
which the courts have said is provided there is only a de minimis impact, and of course that is subject to interpretation, presumably by the court system ultimately.
Right, but that actually is consistent with. The de minimis impact is consistent with the Department of Labor's interpretive bulletin, because if your alternative investment has de minimis impact, then it's an all things being equal standard.
Right. But I think the fiduciary standard, the fact that you are not allowed, that the law is so clear that we don't have the authority to modify fiduciary duty, that we can only do something that a court would find has de minimis impact, that ERISA, there's a relevant clarification of ERISA that while you can do it, you may not do it in a way that comes at the expense of the financial interest of the plan's participants or the beneficiaries. To me, that says you can only do this in cooperation with the plan. That's the bottom line. I don't think you can really force the plan to do something that doesn't find in its interest.
And that's what Draft Bill 11 does. It does leave it tries to skate that line, which I think it does. And it simply says fiduciary duty is first. The benefit, the beneficiaries come first. Their duty is to have as much, to gain as much investment returns for as little risk as you can. But think about getting out of these fossil fuel companies, to the extent you can.
That's what the legislation kind of does.
That's what the amended draft
think about
bill
doing this to the
11.
extent that you can, because we recognize that
Right.
we are not able to direct you to do something, but we want you to know that that's what we would like you to do. That's essentially the outcome of the legislation.
Yes.
Right. Okay, so I just wanted to establish that, because I think it's important.
That's the outcome of the amended resolution, the amended legislation.
The amended.
Not the
that would be
original
the
bill.
outcome of the amended legislation.
Yes.
Okay, one of the concerns that has been raised by the plan is that the legislation would put confusing rules into place for fund managers, or challenging rules into place for fund managers, and we might lose access to fund managers. Ms. Herman, I think you testified that that was one of your concerns, is that the plan could lose access to fund managers, or that fund managers would charge higher fees, and that they would charge higher fees. So I would like to find out more about that. First of all, again, what share of the fund is invested through the broader funds that are not subject to this rule, or that would not be subject, that are exempted by the legislation, and what share is invested by these fund managers who would be affected by this well, actually, who would not be affected by this legislation, but who would be on notice from, I don't even know exactly how it translates down to the fund managers, given that we cannot make them do something. But
Right, right. So let's start back with the actively managed separate accounts. So roughly 70 to 80% of each fund, each trust fund, so the ERS, the Defined Benefit Plan, and the Retiree Health Benefit Trust, is invested by these separate account managers.
70 to 80%?
70 to 80%.
So only 20 to 30% is in these broad kinds of index funds and mutual funds?
Well, we don't hold any mutual funds.
We don't
So
call them
those-
mutual
That 20%, imagine, we have a lot of private equity funds. So we were a very early investor in Google. And that's what we do with about 10% of the fund is in private equity.
You guys
We
were
are-
early investors in Google.
Yes, yes, yes. We are in
You
many.
should get fund advice from these guys, I think.
Well,
Wow.
Yeah, the performance, if you look at our returns, you would see that we're ranked very highly compared to our peers across the country.
Yeah.
So we have about 10% in private equity. That's exempt from this legislation. We have another 10% in private real assets. Real assets meaning real estate, timber, we have farmland, things of that nature, real assets. And then we have another probably 5% invested in hedge funds, which are commingled vehicles. So they're commingled in nature, they're exempt.
Okay, and then
so
the rest is
subject to this legislation.
bid out to managers? Like, what happens to the rest? How does it all work?
Sure. So when we hire an investment manager, so we have different mandates. Imagine that we have stocks, bonds, we have commodities, we have real estate, we have a variety across all the financial markets. So when we're looking for a manager, we're looking at a manager who has good risk-adjusted returns, a manager who has good, strong procedures, policies in place to run an efficient portfolio for us. So when we look at the manager, we do what's called due diligence. Most of our managers have an average tenure with us of 5 to 7 years. So we don't hire managers day in and day out, different investment managers. By an investment manager, I think of T. Rowe Price in Baltimore. We don't use them, but they're an investment manager. So we're looking for these managers who can produce strong risk-adjusted returns for the plan. The board believes strongly in environmental, social, and governance policies. You saw in your packet a copy of our policies that the board has designed. We believe having those good policies in place at an investment manager level produces stronger returns. Governance is very important to us. Having an independent board of a company is very important. Bob mentioned executive compensation. That's very important. Having good social policies, EEO policies, promotional opportunities for employees, things of that are very important. And environmental is very important. We have commodity managers who we want to make sure there's been no violations, no environmental violations, no regulatory issues that they've encountered. So we hire the investment manager, and we give them a mandate. So you're going to manage this money. Let's say it's for long-duration bonds, so bonds that are out 10 years or greater in length. So then they take the money and they begin investing it. So they evaluate companies to invest in, and they put together a portfolio for us, and we monitor it and meet with them.
Okay.
And so forth.
And as a result of this legislation as amended, what would be the conversation with fund managers? How would the process work and so forth?
Well, currently they report to us on a quarterly basis. We have quarterly calls. They tell us what's going on in the portfolio. We ask them questions related to a variety of things, ESG being one of them. You know, what's going on with this company in your portfolio? Why did you sell this company? What the legislation does is require the manager to determine the word de minimis. The manager is a fiduciary in their contract to the board and to the trust fund. They can only do what's in the best interest of plan participants. So to require them to look at a company to say, if you sold it and you sold it for a loss of $2,000, is that de minimis? Or if you sold it for a loss of $10,000, is that de minimis? Having a manager define that, the court case that Bob's referring to, the manager didn't define de minimis.
Right.
It was defined by the plan fiduciary, by the court, not by an individual investment manager.
Right.
So what you're asking the manager to do is go in and say, I think it's okay to take this loss. First of all, let me step back for a minute. Most managers may manage 500 different money for 500 different clients.
Right.
We're one of their clients, Lockheed Martin might be one, and so forth. They manage the money roughly the same for every single client. So when they trade a block of stocks or a bond, they're trading it across all the portfolios in tandem to get economies of scale, to lower fees. They're a trust fund manager. This is what they do for a living. Once you ask them
Okay,
to
can I just
step up-
pause you on that? So you did provide the information,
Right.
what those managers, what companies those managers are.
Right.
Can you further provide information about how many clients they also have? I mean, it is
Sure.
relevant if we are asking ourselves to be managed differently than their 400 other clients. That has an impact.
It does.
If it's more of a boutique environment where they are doing something special for us anyway, then that's a different impact.
Certainly, we can provide that information.
My bigger question is, you have suggested that putting this onus on the managers might cause us to lose access to managers.
Yes.
So I'd like to understand what the risk is of that. Could we look at, the performance of our managers over the last 5 years compared to the average performance of managers?
Right. If you look at Circle, let me just take a moment to find it. It is on Circle 36 in your packet. And what this does is compare the returns of the managers that are actually holding these fossil fuel companies to their peer groups. So if you start at the top under the ERS, you see 3 equity managers and 4 fixed income managers.
Wait, sorry, slow down.
I'm
Circle
sorry.
36, you said?
36.
Okay.
Yeah.
Okay.
So what you see here, so we have 3 equity managers in the ERS and 4 fixed income managers in
Just
the ERS.
for anyone in the audience, there may be memos in the back if you haven't got one. Sorry, go ahead.
So within the ERS, we have 3 equity managers and 4 fixed income managers that hold these fossil fuel companies. So what we're showing here is the market value of the portfolio they manage for us. We're showing you their 10-year performance ranking in that peer group against their peers. We're showing you the median return of the peer group, and we're showing you the return difference if we had to move away from the manager that is managing the money for us. So if the investment manager said, we cannot manage money in this fashion, we manage money based on our best ideas, and if you want us to eliminate a stock or bond, we maybe can't work with you anymore. Many of the managers we have are closed, meaning their strategy the market can only handle so much money in their strategy. Some maybe will be a small company manager. So they can only manage so much money, otherwise they'll move the market when they try to buy or sell a stock or bond. So many of our managers are closed. They're not taking on new accounts. So what we've tried to show you here is the return difference between a median manager and our manager. And you can see the difference in return is $23 million for just the ERS. If we look at the Retiree Health Benefit Trust, the difference between our manager's return and the peer group is $4 million.
Okay, so that's a potential fiscal impact. If it were the
Yes.
case, and this is all within ranges, but if it were the
Absolutely.
case that our fund managers, that, we ended up with fund managers who were more like the median fund manager, then over the last 10 years, we would have had $23 million, well, together $28 million nearly in lower returns to the funds.
Yes, yes,
Okay, so that's
yeah.
an important piece of information.
And then on the prior page was the impact of higher fees. So if they said, we can't do it, but you can be in our commingled product.
Oh, yeah.
If a commingled product was offered.
Where's
So
the
this
following
is,
page
that's
on Circle 37?
35, I'm sorry.
The previous page.
So this is where we tried to show on an annual basis, if we had to move to a commingled product to have access to the same manager, the difference would be almost $3 million annually in higher fees.
$3 million annually, so
In
over 10
higher
years,
fees.
that'd be $30 million.
Yes, yes.
Okay, so this is where it gets to be challenging, right? I mean,
Yes.
we fight like cats and dogs up here to scrape together a few $100,000 to fund the Office of Sustainability, you know, to add positions to the county government so that we can plant trees and educate residents about, you know, energy efficiency in their homes, and to implement all of these leading environmental policies that we have, and we aren't able to fund them. I know that folks in the Sierra Club are here. They've been working really hard with us to get funding for some of these positions. If this decision had a fiscal impact of millions of dollars a year from the fund, that has to be made up somehow, presumably. So, well, it has to be made up somehow. So that is the challenge. And, you know, that's what, I think what that further speaks to is the need to figure out a way to do this with the Board of Investment Trustees in a cooperative way where those kinds of risks can be mitigated, and you can find investment managers who are not at the median and yet can figure out how to invest in a way that is more socially, environmentally responsible. And I do think you can do that if it's a greater priority. I believe that the ESG policy may have a positive impact on governance, you know, picking companies that maybe have a better philosophy about governance, I guess, but I'm not terribly impressed with what the policy has yielded on the environmental side. I mean, it doesn't seem to have had an impact on the environmental side, and I think you could do better than that. I really do. Mr. Wren, did you?
Yes, Mr. Reamer, let me speak to the point you make, because I think that is the point. First of all, I'm Gino Wren. I'm here in the capacity of chair of the Investment Board of Trustees. Let's step back in time a moment. First of all, let me say that when you view an employee's total compensation package, the value of employment with any employer is weighed by individual workers by their total compensation package. Are they competitively compensated in wages? Does the employer provide a path to a retirement, a comfortable and stable retirement? And does the employer provide adequate and affordable health care so they can take care of their family's health needs? And I would submit to you that, having been a labor leader now for 36 years, retirement always comes up as number one with our members. And so we have been very aggressive over the years at the bargaining table to help strengthen, to work with the county government, to help strengthen the pension fund, to assure that the members, the participants, have a comfortable retirement, one that they earned for many years of service. Now, if you accept that premise, let's step back in time. When the recession hit, our fund, just like every other fund across this country, took a brutal beating. We lost hundreds and hundreds of millions of dollars of assets. And it plummeted us from a relatively strong fund to one that was in trouble. And by virtue of the excellent team, I mean excellent team, comprised of Ms. Herman and her staff, who are just outstanding, skilled, and experienced money technicians, I would suggest, and the dedicated trustees, whose combination of labor leaders, department heads, representatives from the retiree groups, and experienced and expert public representatives. And I must say the particular public representatives that we have on that board are just top-notch. They're
Steve
some of
Farber
the
is
best
the
in the
best, I
country.
gotta say, too, you know.
And that's right. Mr. Farber's on there. That's right.
Nice to hear you compliment Mr. Farber.
Now, think about this a minute. I think we dipped into, what, the 70s?
78%.
78%. Now, you may think, 78%, so what? Well, 78% and 100%, that's a pretty big gap. And that's not a gap you can close overnight. So when we were confronted with that loss and that challenge, we really rolled up our sleeves and understood that we had to do some things that we otherwise might not do to get that fund back into a good place. And I'm proud to say, because of that commitment and those efforts, we're at 91% funded. Why is that important? Well, it's important because we've narrowed a gap, but finally, we have in sight the possibility of getting to 100%. Why is that important? I can tell you. Once we hit 100%, what does that do? That further safeguards the pension benefits for the participants, right? It will potentially relieve the burden on the taxpayers and the active participants in the fund. Because once you hit 100%, you can step back a minute and do some things that slow things down, get into more conservative investments if you so desire. Do things to really wall off risk. We're not there yet, but we're getting very, very close. And all the bargaining cycles, the struggles between the county unions, but unions across this country and employers, it's no different, tend to center around retirement and health care. And every union, every employer that participate in joint funds have an objective in mind. Try to wall off your risk as best you can. But you can't do that without closing the gap between the amount of assets you have and the obligations that you have to meet. And we have done that better than most on a national level. Now, here's the problem. None of us on this board of trustees disagrees with the goal. Let's be clear about that. We're not turning a blind eye to climate change. Not at all. We all want to leave our children and our grandchildren a better environment. But we strongly believe that we can move in that direction without the step-by-step mandates that this bill imposes on us. We're not wrestling with the goal. What we're wrestling with is how we get there. And what we're suggesting is, trust us. We're not novices. We'll get there, but let us get there on our terms. Let us be able to fill our fiduciary responsibilities that we all take very, very seriously, and let us develop a strategy to get there over time. That's what the debate's about at this point. I think we thread the needle to that issue.
Well, I think the law is very clear that there is no other alternative for the county council, fundamentally, because your fiduciary responsibility is inviolate. You know, we don't have the legal authority to affect your fiduciary responsibility, and so the power is in the hands of the Board of Trustees. We can create rules that create headaches, but, you know, what would be better is a meeting of the minds between the Board of Trustees and the elected officials in the county to figure out a way to do better, you know, to move to the goal. And so I just want to continue to explore how to do that. I just wanted to also observe, you know, the question of whose money it is really important, right? This is compensation, and it's fundamentally no different than a paycheck.
Exactly.
And telling workers that they aren't allowed to fill up their tanks with gasoline because it's taxpayer money is pretty similar to telling them how their pension funds can be invested. And it's different than a university, right? Universities use these funds to offset their operating expenses. We don't do that.
Right.
You know, it does have an impact on our operating expense, but we don't have an investment account somewhere that we are raising returns through in order to pay the operating bills of the county.
That's
These are
correct.
pension funds, and we have an obligation to them. So that's another reason why I just think we have to be respectful, to the employees whose plan, and the retirees whose plan this is. So we have more work to do. Final question I wanted to ask. I participate through the 401k style plans. Could we offer, and this is not an alternative, but could we offer a fossil fuel free fund through the 401k type plans as well? Again, this is not a substitute. I'm not suggesting that. But I opened up a very small investment account through a bank that is a fossil free fund. I did that a few months ago. For my son, it's just, but they do exist. And I think there might be a lot of employees who don't, through their 401k type plan, who would like to be able to direct money to that. So do we have that option today, or?
You absolutely do.
Oh, we do have that option
You do
today.
through the self-directed brokerage window. Please keep in mind that we get calls monthly for people who have different social types of investing they want to do. Some people don't want to invest in anything that would have a firearm. Some people, firearm distributors like a Walmart within the portfolio.
Right.
Some people want to be free of contraceptives. Some people want to be free of Israeli issues or other global country-related issues. So for the board to say we're going to set up a fund that you can invest in, and there's expense associated with setting up funds because the fees are based on assets under management.
Yeah.
So if you go through the self-directed brokerage window, a person can select whatever type of social investment they want to do. And that's what we direct participants to do. It's on our website. It's in our literature about your plan.
You allow a person to create a targeted, a very precise fund.
Right, they can select it, and we have reduced fees for those because we're associated, Fidelity is associated with those fund families. You may have heard of Calvert Group locally. They offer a lot of socially responsible investments.
Yes.
So we encourage, and Fidelity, we have an on-site rep who, when a participant is interested in a fund, will direct the person, here's different fund families, Calvert is one, there's some others, where here's the phone numbers, here's how you can, start your self-directed brokerage account.
Okay.
So you could actually, Councilmember Reamer, take a portion of your RSP account, move it to the self-directed brokerage window, and invest in that
I
fashion.
don't trust myself really to do that,
Okay.
but
Smart man.
yeah.
It
My dad's a
might-
financial planner. My mom and my dad run a financial planning business. So
Okay.
I grew up learning about the value of index funds. And my dad was one of the very
Absolutely.
early movers towards index funds,
Mm-hmm.
back in the 80s, in the late 70s, and he always preached the value of broadly held funds and eschewing active management, which is interesting because it's not really our BIT's philosophy, frankly.
Not for large
But,
pools of money. Indexing works out for individuals, but large pools of money, you can get economies of scales and fees that you can as an individual.
So in any event, I would like you to look at, again, this is totally separate, but could there be a clearer ESG-based option in the 401k type plans where it's more than, well, you can create your own personal plan, but it's something that's available to
Okay.
people. I think there might be an audience for that, but anyway, I think we have some more work to do with the BIT to find a solution here that, we are not allowed to affect your fiduciary duty. That is not something we have the power to do. So I think, nevertheless, I do think there's broad agreement that we need to achieve a reduction in our fossil fuel holdings. So we want to hear from you how we can do that. That's what I would like to hear.
And might I also suggest that since we're going to have another work session, based on your questions as to how investment managers work, how they structure portfolios, we could bring in a few of our investment managers and they could walk you through how the ESG factors enter into their decision making. Might that be something that would be helpful?
Possibly, we can
Okay,
confer
okay.
on that. I mean, I won't say yes or no, but
Okay.
let's find out more.
Okay.
Thank you.
Mr. Chairman, Mr. Berlin, if I may add, first of all, I want to say I totally respect your passion on this issue. And on a personal level, I'm very passionate as well about this issue. So, you know.
I believe your union is actually
Yes,
pretty
yeah,
passionate about this.
you know, this
I think
is-
your union actually
Yes,
supports.
this is a-
investment.
this is a
Can we say this on the record?
Well, our executive board, which I have no vote, I'm a tiebreaker, believed that there was wisdom in passing a resolution supporting the goal, not how we get there. But that being said, this is a conflicting issue for me for various reasons. You know, I'm also a retiree, so I have a vested interest in this whole issue on a personal level. But, you know, I have had, because of this issue, I have had to do more research and educate myself on divesting in fossil fuels than I ever really had any interest in doing. And here's what I would ask the council members to please accept and understand. There is no data that you can point to and say that taking this action has any really material change in fossil fuel practices. And the academics are all over the map. Yale thinks one thing, Harvard thinks another, Australia thinks one thing. I mean, there's no global consensus on the impact of taking this type of action. However, there is data that you can point to confirm that putting your efforts and resources in changing consumer behavior does have an impact. Point being, there are a lot of products that arise from fossil fuels. And think about this a second. Montgomery County is probably one of the biggest consumers in the county. Now, I would submit to you and suggest to you that if we put our efforts and resources in consuming alternative products, I believe that we would have a far greater impact in that regard. And, you know, it's one thing to pass, and I don't mean this with any disrespect, believe me, to anybody. It's one thing to pass a feel-good piece of legislation, but another to contradict the intent of that language by your continued behavior. And I think that's an important part, that's an important dynamic that has to be weighed in this discussion going forward.
I'll just observe, as I think you know, that in part it's a function of good work that Mr. Reamer and I did. Our county only consumes renewable energy. We are net neutral carbon-wise as a county, okay? So do know that there is hardly a major initiative that our county has not adopted, which has made us one of the most sustainable communities in the United States of America. It's something that I think all of my colleagues are quite proud of. So it isn't like we are saying, gosh, we have more to do there, but we'll pick on this piece. It is we have done all those other things, and we believe this is part of the portfolio that we need to attend to. So I know you do appreciate the work that this council has done.
And I commend you for that. I'm not disagreeing that you haven't done that.
Okay.
But I think there's still a lot of work that can be done in the consumer area. I truly believe it.
Let me turn to Mr. Katz.
Thank you very much. I'm sure the people in the audience and who are watching us think there's nothing else that could be asked on this topic at this point, and my colleagues have certainly covered this sufficiently. However, I do think it's necessary. Mr. Drummer, I would assume the reason there is a board which is now set up, both boards, the investment trustees and the Consolidated Retire Health Benefits Trust Board, is because the county way back when said, look, this money is not, once it is given for the retirement, that the money is no longer the county's money, it is someone else's money. I mean, the county certainly participated and sending that money over, but it's no longer the county's money. Am I sort of right on that?
Yeah, I think you're absolutely right on that. I mean, it's part of the compensation that was already paid to the employees. It's set aside in a trust fund for the exclusive use of the beneficiaries of the trust fund, who are the employees and former employees who are now retired. So it needs to be distinguished from the money in the general fund that the county has. The council has the responsibility to use that money for the benefit of all the residents in the county. This money is segregated. It's actually used to be tax money. It started as tax money, but it's not anymore.
Well, and you could say the same thing for when an employee receives their check, at every 2 weeks or whenever they receive their check. That used to be county money, and it's now their money. I mean, and to that degree, I think it's very necessary to keep in mind, as much as we would like everybody to do, not smoke or whatever we're discussing, once it's their money, they have a right to do smoke. They have a right to buy what they would like to buy. The point on what I'm trying to make is that I'm concerned that people have a fiduciary responsibility on this board. No one that I know of, who I know on this board and beyond, it takes that responsibility lightly. They want to do what is the right thing as an investment for the retirees and employees of Montgomery County. And to Mr. Wren's point, I think that the goal is the easy thing to agree on. It's beyond the goal, which is the difficult thing to agree on. Nobody wants air climate, I shouldn't say no one anymore. You can't predict what anybody wants, I guess. But no one should want air climate to be a worse climate. No one should want someone to breathe air that's not the best air. Everybody wants to do the right thing. The question is, how do you get there? And there again, I'm agreeing with Mr. Wren, I guess more than I've ever agreed with Mr. Wren right now. But I'm agreeing with Mr. Wren again, saying that and to Roger's point and to others, the county is trying to do their best to spend our money the way that we should be spending our money, to try to make things more sustainable, to buy fuel-efficient vehicles, to do all of it, to invest our money in mass transit, to do all of those things that are so very necessary. But my concern is that it cannot get lost that this money that we are saying, oh, by the way, we're putting a hook on the end of it and say you can't use it this way, to me, is not allowing somebody their fiduciary responsibility. The other side of this, and I know that it gets nice and confusing, and it should, because we're dealing with money, but for Erisa, the idea being that someone could a group could take it to court and say we don't like the law, but that for the individual stock that you couldn't take it. My concern, candidly, and who knows what it'll be, but my concern is if we said that you have to divest of Mobil, I'm making a name up, Mobil Oil, but if you have to divest of Mobil Oil and you say, okay, we're going to replace it with the XYZ fund, and the XYZ fund is only raises, the price goes up very slightly, but Mobil Oil went up 10 times, then someone could come back and say, oh, by the way, you didn't do what was responsible. They have an actual example of what did and didn't happen, and I don't know how that would fit into someone's suit. Did you want to?
Well, you could sue.
You can sue for anything. I understand.
Well, I mean,
we have been. I guess,
right. You need $85 and a typewriter.
Yeah.
But you can. You could sue the individual board members for breach of fiduciary duty. As a beneficiary, it would be a difficult suit. But if they clearly did something, it would be more likely. I mean, if they sold or bought some company because they wanted. They had some ownership in the company. There was a conflict. But, investment managers make decisions all the time that some work and some don't. That's the nature of the business. I mean, there is no investment manager that picks only stocks that go up.
But in draft 11, the way I've read it, at the end, it does say that the county would indemnify the the fiduciary of the on the boards. And there's a reason, I'm assuming, that we would have put, that would be considered to be put in.
Yeah, that's a provision that we would defend and indemnify the fiduciaries for following this law. In other words, if they did something that was exactly as we told them to do, and a court ultimately decided that was a breach, or somebody claimed, even just alleged, that was a breach of their fiduciary duty, we would step in and defend them because we're the ones that told them to do it. We did that in 2008 for the divestment law on Sudan. Companies doing business in Sudan, and this would just add it to that. It's similar. I mean, I think if you're going to enact any law that has a potential for, the technical term would be monkeying with the fiduciary duty. It's not really a technical term, but you would want to, you'd want to tell the board members that we're going to defend you and indemnify you, otherwise you won't have board members.
You couldn't.
It's going to be very hard to get somebody to take the job if you're not going to stand behind them after you tell them, I want you to do X, and if you do X, well, you may get sued, but you're on your own. That's why it's in there. It's not an unusual provision.
And I'm not going to belabor the point, but the idea being, for me, what is the great concern is there are two different goals here. The one goal is that our retirees, and there's, we take this goal because you've done such a good job, quite candidly, that we take this, that, this is always going to be the case. There's plenty of places in America right this second that have had huge problems, and that people that thought they were going to have a retirement are not going to have a retirement. And in fact, I read an article the other day that where people, they actually said, and by the way, send back, some of the other money that you've gotten already. This is not something that we should take lightly. We are dealing with someone else's money, and we have to make certain that our retirees who have worked hard for Montgomery County and the people of Montgomery County, that they are receiving what is just and fair. On the other hand, and others have made this point as well, we have to figure out what's the best way for us to help the environment get where we would like it all to be. It's two separate issues as far as I'm concerned. And to the board's point, they're certainly investing in a way that they believe is the proper way, and if they can avoid buying a stock that is not going to be something that if they can avoid it, they would. But the bottom line on this whole thing is if there is two separate issues, I don't believe we're solving what we intended to solve or what was intended to solve with this type of legislation. I believe we need to go beyond this type of legislation. I believe we need to have our continued conversations, but at some point we need to figure out what's the best way rather than spend somebody else's money to try to do this. Thank you.
Before I turn to Mr. Elrich, I just want to clarify for the record, the council has twice before had divestment matters passed. And I believe in both instances, Ms. Herman, the Board of Investment Trustees opposed those as well. Is that fair?
That's correct.
Okay,
That's
so
correct.
the board has, as a matter of principle, always opposed divestment legislation.
Yes. Yes.
Roger, if I could just put, for that point, I think the previous times, it was based on, the two other times, was based on countries for their political reasons. But on this time, it's actually for the business that the stock would be in. Am I correct in that?
That's correct. I think Bob pointed out in his memo that both of the last two divestment actions were a result of federal government, would you call it interactions or laws, Bob?
They were more related to the United States foreign policy, with staying out of South Africa and staying out of Sudan. In fact, the Sudan divestment originally was for reasons for preemption, not because of breach of fiduciary duty. Some of the early situations were struck down by the federal courts, saying that you're monkeying with foreign policy. And there's that term again. And then the Congress stepped in and actually expressly authorized retirement plans, state, local retirement plans, to divest in Sudan and simply notify the Attorney General. So that was done when we acted in 2008. It was after Congress had acted, and it was pursuant to that federal statute. So it was a little less controversial.
But the
Both-
Board of
But it was
Investment
done.
Trustees opposed
Oh, yeah,
that at that
they
time.
opposed it on the, right. They're
Similar-
consistent on that.
They are
yes.
consistently said,
Right.
let us do our work, don't tell us how to do our work.
That's correct.
Mr. Eldridge?
There are so many slippery slopes one could go down. I think it's wrong to say that oil is not about foreign policy, frankly. We've had a few wars that are driven by oil. So I think it's a false distinction to say one's a foreign policy issue and the other is not. They're both, in fact, oil may be worse. I'd argue oil is far worse in foreign policy than anything that happened in Sudan, because we actually go to war for this stuff. We didn't go to war in Sudan. So that's one slippery slope that I'm uncomfortable with. And I'd say, on the other hand, I agree somewhat with what Gina said about county policies. I mean, we're only energy neutral because we buy, lots of energy from someplace else. But the fact is, we haven't solarized our buildings the way we should. We haven't done a lot of things. And I think that I don't want to say that we've done what we need to do based on, a calculation on paper that says we're energy neutral. I really want to see policies. I mean, I think to the point, we'd have more effect on oil and oil companies to the extent that our policies stop buying stuff to the extent possible from these companies in the long term. But I'm a sponsor of this bill because I think it's important. I mean, I think that the climate is probably the most important thing we're going to be dealing with, other than the wackiness in Washington. And so I would argue that, we're dealing with what's happening, say, with the immigration issue right now. And people have asked us, are you going to trade human lives for going along with some of Trump's policies on immigration? Or, people have raised it, what's the cost? Is the government going to impose a cost on us for what we do? Am I going to sell people out for a certain dollar value, even though I know that dollar value is going to affect the county? I can tell you from my moral position, I'm not going to sell people out for dollars. I'm not going to look at the federal government and saying we're going to hold back money if you don't give up your people. I mean, there's something about this where sometimes human life and the well-being of the planet comes above a strict dollar calculation. So you're not proposing that here, but I just want to say that we deal with this in a bigger way. I had some questions about this, and have you all read the amended bill?
Yes. Yes,
And-
Mr. Berliner came to the board on the 27th and explained the amended bill, and we reviewed it.
So, I mean, it seems to me that it's no longer a hard divestment bill. And with the conditions for fiduciary responsibility, it seems to me it doesn't do much more than offer guidance and preference, but still leaves the fiduciary decisions in your hands. So I'm questioning a little bit why, having given so much and taken away the hard part of the bill, why this is still a hard pill to swallow. Could you?
If you look at
Yeah.
Circle 81, Commissioner Ehrlich, you will see the board's memo of January 30th. So Mr. Berliner kindly came to our meeting on the 27th. The board considered the revised bill. And on Circle 81, you'll see the board's response and their rationale for having concerns even with the new drafted legislation.
You think these are concerns that can be addressed and still leave us with direction rather than say nothing?
I think we could continue the dialogue, absolutely.
That's interesting. I mean, I'm not interested in surrendering, and I'm not necessarily saying you need to surrender. But between this position and what Mr. Berliner's come up with, it seems like if there are technical things that don't make it weaker but deal simply with process stuff, that's of interest to me. If you're asking for us to basically be silent and not express preferences, and not ask you to do things, that's a different issue. If at the end of the day you have to make a fiduciary call, then you make that call. And if we're not preempting you from that, I would like to find a way to get to that. And and I've talked with
Yeah.
you about
No,
this.
first of all, to your surprise that you and I are agreeing so much, I've been even more surprised that I'm the face of the establishment. Go figure. But in any event,
It's tough when that happens.
yeah, it's the many roles one plays, right? But here, and I think you're getting to where we really need to focus. First of all, I want to, again, commend the sponsors for rewriting the bill. We are much closer today than we were when we first started this. I'm going to remain cautiously optimistic that we can get to a happy place, okay? And the way we do that is continue the dialogue, number one, but we need a complete understanding and acceptance that we have a certain obligation that we're going to stand firm on that should not be intruded on. Now, if we can bridge that gap, then I think we're going to be okay. We're not disagreeing with the goal. Let me just reiterate that. It's how we get there.
So that gets to the question of, if we're not disagreeing on the goal, and there's lots of sympathy for the goal on your board, is it possible that the board on its own could come back with a proposal to say, this is the way we'd like to go about managing this issue in a way that preserves our authority, but doesn't dictate step by step, but is what you all consider a financially prudent way to make this change? I mean, you all present zero evidence that these represent the best investments in the portfolio. And the example that selling something at a loss, would you want to do that? Well, people who manage portfolios all the time sell things at a loss because they realize the thing that's losing money isn't going to go up anytime soon, and there are better opportunities in the market. So the fact that you might be forced to sell something at a loss might actually be an opportunity to invest in something else, which I would, judging by your portfolio's performance, there are plenty of other stocks which are actually performing better. So I don't see any evidence that we would trigger something that would be necessarily deleterious to the portfolio. I was interested in your comparison to the median, but the other column is where you rank in the percent, and so other than one column, you could argue that there's a better manager out there for every one of those categories because you're only in the top 1% in one category. And the other categories, there are other people obviously who are performing better. I don't know what the cost of another fund manager would be because you all didn't present. We went and looked and we talked to people, and fund managers that do these fossil fuels charge this much to manage the fund. This is what we're paying. I mean, you've made this general rather than specific. And if I was doing an investment, personally, I'd want to know specific rather than general. So I think that there's more that we could know about rates of return in possible non-fossil fuel managers. Are there people who return better than this? Are there people whose fees are comparable or better than this? I mean, you simply demonstrated that we do well, but you haven't demonstrated that we do the best. So I would like to see a continuing dialogue on this. I think the chair has indicated by his last go-round that there's a willingness to talk about things and move things in that direction. And I've heard, at least from Gino, a willingness to move things in a better direction. And if two people want to move in a better direction, I would give you latitude to move in a better direction. But at the end of the day, the product has to be a better direction. I do think we need to find a way as quickly as possible to get ourselves out of this. And I do believe, since there's no evidence to the contrary, that alternative investments will not hurt the portfolio. They're likely to do as well or better than what we're doing now. So I don't see there's no alarming red lights here that say, don't go here, you're going to hurt us. There's just some assumptions that we might. I mean, did getting out of Darfur kill us?
Pardon me?
You have this great performance. Did getting out of Darfur or out of Sudan, did that hurt us?
Well, we didn't get out of Sudan, Commissioner Ehrlich. What happened with the Sudanese bill, the same thing that happened with the South African bill, where there were exemptions. So most companies were exempt. So the Sudan bill did end up, and we continue to pay costs related to Sudan of about $400,000. That's what we've paid. It's $400,000 plus. Remember, the fund isn't funded, so you're paying 7.5% interest on every dime that doesn't go into the fund. So it's $400,000 that we paid so far, plus the 7.5%.
I'd love to see how you're
on the-
paying $400,000.
Well, we send you a report once a year. I
But
can
on
send you-
Sudan?
On Sudan, we can send you the one we sent you in June.
Yeah.
Annually, we're required to report to the board, so we had to hire a consultant for Sudan to rank the companies, to say which company was exempt. The exemption for Sudan relates to making contributions to the Sudanese government to help individuals there. Most companies are making those contributions, so most companies are exempt if they're doing business in Sudan, so they don't have to be sold. The $400,000 represents companies that we did have to sell in the beginning of the bill, plus our annual consultant fee, which I think is $10,000 or $15,000 a year. But it doesn't represent those companies that we couldn't buy. So we're not tracking the ones that we couldn't buy. So our managers, knowing that there's companies they cannot buy, but they maybe would have bought, we could go back and show you if they would have bought that company, what would the return have been.
That'd have been worth it.
Yeah, but we'll be glad to show you the report that we sent over to council in June. Annually, the law requires us to send you a report of the cost of the Sudanese legislation.
Okay, thank you.
Yeah.
Go to Ms. Navarro, who has not spoken yet, and then Ms. Florine. But let me just repeat a question that we actually had a miscommunication on in my last formal letter to you, in which I requested the returns on these companies, okay? And you interpret it as the returns from the investment managers. We have 8 investment managers who deal with these particular stocks, $70 million of particular stocks. My question wasn't about their returns as managers. My question was the returns on those stocks over the past 5 years. So if you would please provide the Joint Committee with that, because that obviously went to the whole impetus here that these are not stocks that have, over the past 5 years, performed particularly well. So if wrong with, now, of course, there is a change in circumstance. ExxonMobil may be doing very well right now. Okay. So again, that's why fiduciary duty matters. And so we're not asking you to do anything inconsistent with your fiduciary duty. Anyway, Ms. Navarro.
Thank you. And I do want to commend Ms. Herman and Mr. Wren and Mr. Farber, everybody who has been doing such a great job, really, truly ensuring that our retirees continue to be able to trust. I mean, we can't say the same thing of other jurisdictions. I think our funded ratio is one that we're very proud of and has been also a result of lots and lots of fiscal decisions on many different levels, especially during the recession. So that's, I think, a very important issue to discuss. Obviously, as chair of the GEO and Fiscal Policy Committee and with my colleagues, you know, this is an issue that comes up periodically, and it's not a simple one, as we have here experienced, but I felt that it would be important to co-sponsor this bill because at the end of the day, just like we do every time we have a piece of legislation, we work through it, we find compromise, we figure out what is the best possible outcome. And for me, you know, given that things have shifted quite a bit from the time that we introduced this bill to now in terms of the national climate overall and the conditions, I think, you know, it would be of benefit if we could hear from you, as Councilmember Elrich had indicated, to see where it is that, you know, we could arrive. The fact that we could even get to a point where we're able to receive annual reports on where we are with our investments in fossil fuels. You know, I do believe that it is important to take necessary steps. You know, sometimes you don't get there all the way at once, but it is important to take necessary steps because it is not as simple as sometimes it's described. And as it was stated earlier, and I was going to make the same point, you know, this connection of fossil fuels and oil and foreign policies, et cetera, it's very real. And we do have somebody that had an oil well behind my home in Venezuela. Yes, it's very real. So there are lots of interesting, I think, intersections and implications, but there is no doubt that our number one priority is to make sure, just as we have, and you know, I want to make sure that's on the record, that this is a council that takes very seriously also our fiduciary oversight in terms of our funded ratios, and we've done that very well, that we continue to observe that, and at the same time that we start moving towards understanding impacts on where you know, the money is going, respecting, yes, that this is money that belongs to our retirees, of course. So I'm glad that we're having this opportunity to, you know, to have the discussion, not rushing into anything, because it does, I think, set the precedent. And that has been something that we in this committee have been very, very attentive to, that, you know, this is not to then begin to find every single category, because then it becomes absolutely not manageable. But I think there are some particular areas that rise to the top of importance, and this is definitely one of those. So I hope that we continue to dialogue and work together so that we can find a compromise. And thank you, Mr. Chairman, for your leadership on this.
Mr. Farber, you had an observation to
Yes,
make?
just a very brief point to follow up. We really are proud of the fact that we're at 91% funded, as Gino said, for our pension plan. But of course, we have the Retiree Health Benefits Trust for the benefit of retirees of the county, but also the public schools and the college. That fund is funded at 21%, not 91%. Now, we should be proud of the fact that that's much better than most other jurisdictions around the country, but it's still only 21%. So we're making progress, but we've got a lot more work to do.
That's a good point.
Ms. Florine?
Thank you. Mr. Farber, would this bill would apply to those funds as well, right?
Correct.
Right, Mr. Farber?
Yes.
This bill would apply to those funds?
Yes, yes, it does.
You know, I'm glad everyone is reaching some consensus that there's some other way here, but apart from putting us in the position of telling the leadership of these really important funds what to do, which I think is a problem, I don't know what problem this solves. If we were to announce that we were going to divest ourselves of anything having to do with fossil fuel, somebody else would take that up. It's not like us saying, we're all going to stop driving vehicles. I'm guessing, I'm not going to embarrass people here, I bet everyone in this room, whichever side of this issue you are on, got here using something employing fossil fuel, unless you walked or possibly rode your bicycle, and Hans might have ridden his bicycle today. But, you know, the county is dependent upon fossil fuels. And I was reading this index company that is alluded to as a reference for all this. And it raised a question in my mind about the bill itself, because the bill defines fossil fuel companies as companies on this index, I think.
It does.
But
it actually defines it as a company with one of the
it's a publicly
top
traded,
200 companies based on amount of fossil fuel reserves.
right.
The list
Well-
is
well,
an identification of that.
Might I point out on Circle 25, the definition is a publicly traded coal, oil, and gas company holding fossil fuels reserves. But that index is not that. It's any company holding fossil fuel reserves, which apparently a lot of other companies do. They list some shipbuilding companies, and I don't know, you know, however the world works in terms of its investments.
Yeah, the top 200 wouldn't just be
They're not
companies
just
that
fossil fuel
produce
companies.
oil, or.
So someone would
it
have to
companies
pick-
that have those reserves.
So someone would have to pick, I guess, amongst those, which one of those we were talking about.
Well,
because-
that's what this company, the Fossil Fuel Free Index does.
But it's
It
not
looks
just
at-
about oil and gas companies, is my point.
Right, that's right.
So there is an internal inconsistency here about whatever it is that is because then it says the boards may refer to the rankings to determine if a company is a fossil fuel company. I'm just pointing this out by having reading their website, and I'm no expert in any of this. They also say that, and it's an interesting website and company, the Fossil Fuel Index Company, they don't say that they have a position on the percentage of fossil fuel reserves that should remain unused by 2050. They don't say none of it should be used, which is an interesting perspective. So this is not about banning the use of fossil fuels reserves altogether. It also raises the question in my mind about what about the companies investing in clean energy? Some of these companies diversify their investments and their holdings and their activities. I don't think, how would that be addressed? Clean energy, of course, nuclear power is another area of huge community debate. I don't know, this leaves that alone, I guess, but that's another policy issue that some people would say it's the cleanest energy. People argue about this stuff. So I'm just saying it's not a clear path on the apart from the fact that it sounds appealing. If you read the details here, it's not so straightforward about what you're talking about. And I think it would be difficult for the Board of Trustees to manage it, even under if we were to say, we wish you'd think about this, I mean, we can all say that. And it sounds like you do think about this as a Board of Trustees. But giving you direct guidelines, suggesting that you adhere to one approach that has chosen its own path, it sounds interesting, and maybe it's what you'd want to do. But there might be other competing sets of priorities that investors would want you to keep under the aegis of responsible investing. I'm not sure that we are the ones to tell you what the most responsible approach to investing is in socially good things. I mean, if the county were to say, okay, everyone's going to walk to work from now on, we're not going to have any parking, and we're not going to have any parking for our residents, and because we're opposed to the use of fossil fuels, at least we'd be making the statement that we're not supporting that lifestyle choice, and get over it. If we were to say we won't buy, I don't know, if we're not going to buy gasoline except from companies, or fuel except from certain kinds of companies where we approve their investments, I mean, maybe we would make a little bit of a statement there. But I'm not sure how this gets us to the policy that we'd like to see advance, which was really the clean energy initiatives, which everyone is pretty much in support of. But this could have the opposite effect on those companies based on the holdings of some of these other companies that hold reserves. And I'll note that you might hold a lot of reserves for the point of sitting on them, which if under this fossil fuel investment index, I mean, that might be a good thing. I mean, if you were some huge investor or a company that had nothing but the purest of intentions about fossil fuels, you might decide, okay, I'm going to own all the tar sands in Canada, or all the oil underneath the earth, and to sit on it. and then no one else can have it. And of course, that's pretty unlikely, but on the other hand, who knows? These days, every day, what comes out of number 45 is a surprise, so who knows? So I think it's difficult to assume what is the right approach these days.
Well, I see no other lights from my colleagues. I thank everybody for, Mr. Emer.
Sorry. I just wanted to sort of summarize. So from my perspective, we're still working on this, and the dialogue's going to continue, and we're going to work towards a solution. That's where I'm coming from.
Yeah, and to that point, I conferred with the executive director. We're going to take a stab at putting together an outline of how we can move in this direction. At a quicker pace, I would
At a quicker
submit
pace?
that we are moving in this direction.
Well, appreciate that. I guess I do struggle, as some of my colleagues and Mr. Elrich have articulated, is given that this bill does say in no uncertain terms that your fiduciary duty comes first. To me, what is playing out here is that this is a matter of principle that we should not tell you, even when we affirm that no action should be taken inconsistent with your fiduciary duty. It's not our prerogative to tell the Board of Investment Trustees to look at these investments. And at the same time, you tell us that you have an ESG policy that looks at these investments. So what I don't understand is how, if you have an ESG policy, how this isn't a logical extension of that very same policy that imposes no more of a burden than what you claim is already true, which is that your investment managers are required to look at these issues. So I, like some of my colleagues, just struggle as to whether or not this is in fact drawing a line in the sand, saying, in Sudan and South Africa, we said no, and we're going to say no now. Keep your nibby nose out of our business. Okay? So if there's a path forward, I've spent most of my life in public service and before trying hard to find common ground. Okay? This version of the bill was my effort to find common ground, to recognize that I don't want the people in this audience who are retirees to suffer as a function of these values. So I, too, am open to furthering this dialogue and seeing if we can't get to yes. That's always my first priority, okay? So look forward to future conversations. Thank you.
Thank you.